Well, U.S. stocks, as you just saw, rising now a fifth straight session. That's the longest winning streak since November. For more, let's head down to the floor of the New York Stock Exchange, where we find our Suzanne O'Halloran. Suzanne.
Thanks very much, Lori. I am here with Diane Garnick. She handles $400 billion in global assets, and we're going to talk about this market. Diane, what's your thoughts? Can stocks continue to move higher?
You know, one of the things that we've been really concerned about is the level of ability to spend on the part of consumers. It's not only that credit has been less available to consumers, it's also been that reluctance or that hesitancy for consumers to spend. We saw a lot of this happen in the back-to-school season, and we're certainly expecting a lot of that to continue into the holiday shopping season.
How much of that is already factored into the market? I mean, we had Walmart CEO, as we talked about just moments ago, saying that consumers are deferring purchases, but yet we have stocks up 50% since the March low. So investors seem really euphoric. Do you think what's going to drive us even higher than we are now?
You know, one of the things that I think has been really important when we talk about these tremendous gains that we've had this year, it's on the heels of some pretty horrific selling. So I think one of the realistic things that we have to think about is, yes, we're likely to have growth, but the growth rate that we had before this recession started is not likely to resume in the short term. We're probably going to have a longer period where we have very mild growth, kind of consuming the U.S. market.
Okay, what about earnings? We're approaching the earnings season that's coming up. We got some good news today from Procter & Gamble. What's your general outlook on how earnings might come in?
You know, it's interesting. Last quarter, we had a lot of euphoria in the market because people decided, earnings were so much better than our expectations. But remember, the reason earnings did so well, 76% of the companies in the S&P beat earnings expectations. They did phenomenally well because they cut expenses. And we can see that in the higher unemployment. We can see that in a lot of different places. The bottom line is cutting expenses will only get us so far. It's that top-line growth or sales growth that we'll really need for earnings.
Great. Diane, we've got to leave it there. Our thanks to Diane Garnick of Invesvo. Lori, handing it back to you.
And thank you, Suzanne.